Central Park penthouses and nine-figure valuations are the standard iconography of the global elite. But behind those headline numbers, a catastrophic liquidity crisis is unfolding. For the first time in decades, individuals with massive paper fortunes are finding themselves insolvent, watching their net worth evaporate as their fixed lifestyle costs outpace their available cash. This collapse is a reversal of a 15-year trend. For over a decade, a 0% interest rate environment allowed the 1% to use leverage as a tool for infinite growth. If you had $100 million in stock, you didn't sell it. You borrowed against it at a 1% interest rate, living like a king on tax-free bank credit while your assets continued to climb. This chart shows the benchmark central bank rates underpinning that entire wealth strategy. For 10 years, borrowing costs were negligible. But when inflation surged, the Federal Reserve aggressively tightened policy. Rates violently spiked past 5%, sending a shock through the global financial system. This rapid shift in the cost of capital did more than create paper losses. It triggered a fatal chain reaction across three foundational asset classes, dismantling the modern architecture used by the elite to protect and grow their wealth. To monetize their portfolios without paying capital gains tax, the wealthy relied on buy, borrow, die. They pledged their stock holdings to private banks to secure securities-backed lines of credit, or SBLOCs. These facilities provided the liquid cash needed for luxury real estate, private equity commitments, and high-end estate management. The math turned toxic almost overnight. As benchmark rates rose, the interest expense required to service these lines tripled or quadrupled. At the same time, mark-to-market revaluations caused the underlying stock collateral on the right to plummet, creating a pincer movement on the borrower's balance sheet. This triggers an automated response from bank risk departments, the margin call. Borrowers are given 24 to 72 hours to post millions in liquid cash, or watch the bank liquidate their core assets during a market drawdown, converting temporary paper losses into permanent capital destruction. But because most ultra-high net worth individuals have their capital locked in 10-year private equity cycles or restricted shares, they often have zero cash on hand to satisfy the bank. They are essentially broke, unable to access the very wealth they spent years accumulating. Desperate to stop the liquidation of their stock portfolios, these investors attempt to extract cash from their safest historical haven, commercial real estate. For decades, commercial real estate was the bedrock of elite wealth, a reliable inflation hedge, and a steady source of yield for family offices and private equity syndicates. However, commercial mortgages are not like residential ones. They are structured as short-term debt, usually lasting 5 to 10 years with massive balloon payments or refinancing requirements at maturity. Every building in this skyline eventually hits a refinancing wall. Buildings are valued using capitalization rates or cap rates, which is the net income divided by the market value. When risk-free treasury yields rise, cap rates follow, automatically crushing asset values even if the building is full of tenants. This leads to an equity wipeout at the maturity cliff. If a property once valued at $200 million is reappraised at $100 million, the owner's original equity dissolves completely. The new value is now less than the original debt. Banks refuse to roll over these underwater loans. Instead, they issue mandatory capital calls to the investors, demanding immediate cash to bridge the debt gap and keep the building from foreclosure. For limited partners already struck with margin calls, these demands are impossible to meet. They are forced to surrender the titles directly to their lenders, walking away with a total loss on their investment. With commercial equity gone and credit lines frozen, the wealthy are backed into a corner, forced to liquidate their most personal assets, their primary homes. Physical assets are becoming a drain. While common inflation metrics focus on groceries, the cost of living extremely well index shows that expenses for domestic staff, estate management, and elite prep schools have exploded. Keeping a $20 million estate running now requires an after-tax burn rate that many can no longer sustain. To stop the bleeding, an investor might try to sell their coastal mega mansion only to find that high-end real estate has become a toxic asset. Due to systemic modeling for wildfires and hurricanes, major insurers have pulled out of coastal California and South Florida entirely. They are no longer writing policies in the very zip codes where the elite have concentrated their wealth. This creates a terminal leverage trap. High-end mortgages require active insurance. When coverage is cancelled, the bank can declare a technical default demanding an immediate payout. Because no one can get a mortgage on an uninsurable home, the property must be sold for cash, instantly wiping out 30% or more of its market value. The liquidity trap is now absolute. The stocks are frozen, the commercial equity is gone, and the primary home is an unsellable liability. On the surface, the individual still has the title to a company and a mansion, but beneath the headlines, the balance sheet is decimated. They are technically insolvent, trapped by the debt that once made them appear invincible. Maintaining an elite status requires constant massive cash flow. The country club dues and estate staff don't stop when credit lines freeze. When the cash runs dry but the social expectation of wealth remains, the pressure drives a pivot toward crime. We are seeing business owners risk federal prison for COVID relief fraud or operate investment funds as Ponzi schemes, doubling down on high-stakes deception just to keep the lease on a supercar for another month. The global financial dragnet is also closing. Over 100 countries now automatically share banking data through the Common Reporting Standard, eliminating the offshore secrecy of the past. Those attempting to relocate now face mark-to-market exit taxes, where the IRS treats a departure as a total sale of global assets, taxing unrealized gains before the individual can leave. When the 1% experience a liquidity crunch, the impact trickles down. It starves the service economy, kills startup funding, and puts pressure on regional banks where most families keep their savings. For 15 years, the market prioritized leverage and paper appreciation. In a high-interest rate world, that model has become a liability. Stability now belongs to the solvent, those who hold liquid reserves and own their assets outright, free from the demands of a bank.